Chapters 5 and 6, Lecture Part 1. In these chapters, we're going to go over accounting for merchandisers, and what we're going to do is go over the operating cycle for a retailer, the big picture. So if you're a merchandiser, you're not like a service. A service provides their service, and that's their revenue. When you're a merchandiser, you have to purchase merchandise. So when you purchase merchandise, you're dealing with suppliers and vendors. And because you deal with suppliers and vendors, usually when you buy your merchandise, you're going to purchase that merchandise on account. And when we were purchasing merchandise on account, you're going to deal a lot with the accounts payable account, so AP. So you buy your merchandise, and then after that, you turn around and hopefully you make some sales. And when you're dealing with sales, you're dealing with customers. So you not only deal with vendors and suppliers, but now you're also dealing with customers. And with customers, usually you're selling that on account. And if you sell your merchandise on account, that's going to deal with the accounts receivables. Now you're waiting for your money from your customers, and there's a big emphasis on collection of that money. And now once we get our money, that's our cash, and we got to turn around, use that cash to pay off our suppliers and our vendors whom we purchased merchandise originally from on account. And that is your operating cycle for a merchandiser. Why it's very difficult, more challenging than a service business who only deals with customers. Now let's compare a service business and a merchandiser in respect to the accounting for each type of business. So service versus merchandiser. Here we're going to look at the income statement. In the income statement, no matter whatever type of business it is, it's always going to be revenue minus expenses. So let's go over the income statement for a service business. I'm just going to put examples of accounts here for a service business. The first account we're going to deal with is a revenue account, and we'll term this fees earned. If you recall, in our last example or in our last lecture, it was a consulting business, so we called the revenue account consulting fees. So if you see that word fees, it's a revenue account because the business is charging customer fees. Here, I'm going to list a few examples of expenses. I'm going to list rent expense, wage expense, and miscellaneous expense. I mean, the expenses can go on for a long time. There's a lot of it, especially when you're dealing with a legit business. You have a lot of expenses that you have to take care of. So here, fees earned minus all your expenses, or revenue minus all your expenses, gives you your net income if it's a positive number. But if the number results in a negative value, then it's considered a net loss. Next, we'll go over the income statement for a merchandising business. I know it says service business there. I'll correct it on the PDF that I will post. That's an error right there, but it should be for a merchandising business. It's still revenue minus expenses, but it's broken down a little bit more in detail in respect to revenues and expenses. The revenue account is sales. And then the first expense account you deal with is an account called cost of goods sold. Cost of goods sold is what it costs the business to acquire the inventory. So cost of goods sold. Then after subtracting that, you will get what's called gross profit. Once you get gross profit, you want to subtract all your operating expenses. And your operating expenses are into two categories, or broken out into two categories. The first one is selling expenses. So if you have any expenses considered selling expenses, you want to list it under this subsection. And the next one is administrative expenses. So you're going to have a lot of expenses, but you need to list those expenses in either one of those two categories, selling expenses or administrative expenses. You subtract those two types of expenses from the gross profit, and you will get your operating income. After getting your operating income, you're going to add or subtract other revenues and other expenses. Other revenues and other expenses are things that really don't deal with normal operations. The book or textbooks love to give rent revenue as an example of other revenue, and they also like to give an example of interest expense for other expenses, because those two things don't really deal with the normal course of business or operations. So you want to put those under other. Next, you will get income before taxes. So you had your operating income, you added other revenue, you subtracted other expense, and you will get what's called income before taxes. The very last line or line item or expense that we have to consider is income tax expense. And this is assuming that income before taxes is a positive number. So now the government will, or the IRS will tax the business, the income tax expense line. And finally, you will get your net income. So if you look here, it's still revenue minus expenses, but it's just organized in a certain way. So you could see lines like cost of goods sold, gross profit, operating income, income before taxes, and net income. Please remember that when it comes to operating expenses, you must list all your expenses under those two categories. So you don't add them up and have two lines selling expenses and administrative expenses. You want to list each type of expense under each category, okay, for operating expenses. So yes, that list will be very long and it depends on how many expenses you have. And I'm just going over here all the line items once again to show you that it is just revenue minus expenses all the way down. And the key thing you want to focus on is listing each revenue and expense in the proper place, okay, because that's important. Next, we're going to go over purchases. So remember, from the operating cycle of a merchandiser, what you have to do first is secure that inventory or attain that inventory before you can even make sales. So purchases from vendors and suppliers. And I'm just showing you the operating cycle here. It's on the right side from that chart originally discussed in the previous slide. So we have purchases of merchandise, and shows a truck because we're purchasing the merchandise. It's being delivered to us. This affects many things on the purchasing side. First of all, one important thing this chapter emphasizes is the accounts payable subsidiary ledger. So again, it's the AP subsidiary ledger. It's just, in a nutshell, it's separate records for suppliers and vendors. If we were to credit and debit accounts payable and just the word or the accounts payable, we would not be able to tell who we owe and who we paid without showing a detailed record of each vendor and supplier we have. So again, a subsidiary ledger just breaks up the AP account into more detailed information based on your different suppliers and your vendors. Next, of course, we're going to deal with this account called merchandise inventory, because that's what we're acquiring from our suppliers and vendors. This is big, this is very important. The chapter emphasizes it because inventory, it becomes a very important asset. It's what results in money and sales. The key thing here too is inventory is always recorded at cost. So however much the business got the inventory for, that's what you're going to record it at. Merchandise inventory, as a reminder, it's an asset on the balance sheet. And it's a very important asset, again, if you're a merchandiser, because that's what's going to result in sales and eventually money. So your merchandise inventory, you got to do everything you can to protect it and keep it safe. Next, I'm jumping ahead of myself here, but because it's recorded at cost, this is actually the cost of inventory, and it's what's considered your cost of goods sold. So cost of goods sold, when you see that account, cost of goods sold, that's actually that's an expense account. We just went over it in the previous slide. That is a major expense and what you subtract from sales to get your gross profit. So it's an expense on the income statement. Don't get confused by the term. Just remember, it's what it costs the business to get their inventory before they sell it. Lastly, on this slide, it's inventory costing systems. I'll briefly discuss it here, but under a periodic system, you're not keeping track of inventory in respect to sales. What you're doing for periodic is you are taking a physical count, and then you're counting how much you had and what you have left over after each period. And then that's how you determine your sales. So really here, purchases are recorded, but then sales are not recorded until the end of the month. Okay. So purchases recorded, sales recorded at the end of the month. And that's what I was talking about with the physical count. Under perpetual system, which I like to use examples of all the time, purchases and sales are consistently, periodically updated. You know this, or you know from a customer's point of view, you know that a business uses a perpetual inventory system when they know how much they have on hand at any given time. They could tell you the quantity of something wherever it's located at any given time. Okay, so perpetual inventory system, main point, sales and purchases are updated constantly. Next, let's briefly talk about credit terms and net method versus gross method. Credit terms is what is agreed upon in respect to payment or when payment is due. Okay, so credit terms. If you're the business and you're the one purchasing, well, you need to pay the bills, assuming that it's on account. So on the bill itself or the invoice, you'll say something like N30. N30 means that the payment is due in 30 days. The next type of term we have is 2/10, comma, N30. This is actually a discount, or the supplier or vendor is giving you a discount. It could be you if you're dealing with a customer, but we're going to do that later. So 2/10 means a 2% discount on the cost of the inventory if paid within 10 days, or it's just due in 30 days. So this is good if the business pays really fast. They can get a 2% discount off the cost of whatever the business is purchasing. Or if it goes beyond 10 days, it's just due in 30 days. Sometimes you'll see these letters right here, COD. That just means cash on delivery. So when the product is delivered, someone is waiting to give them a check or cash for the inventory or the product. EOM is another term you may see. That stands for end of month. So let's say that it is June right now. So they have until June 30th to pay, the end of the month. So next, we'll talk about net method versus gross method. This is key right here because I'm going to go over a bunch of examples, journal entries. But just to be real specific, under net method, it is assumed that the discount is taken at the time of purchase. Okay? The discount meaning, if you look to the left there, 2%/10, 2% 10 days. So it's assuming that at 2%, it's assuming that they're going to pay early. So the 2% has to be taken off the invoice. Under gross method, which to me is the real world, it is not assumed that the discount will be earned. Again, not assumed that the discount will be earned. So I'm just showing you net method. It deals with the 2% right there. I've been an accountant previously, and we always used gross method, but yes, the textbook does go over net method a lot. So please don't get confused. And when we do these examples, I'm going to let you know, like this one right here, purchase example number 1, I'll let you know that it's net method or gross method. In this case, it is net method. So our first example is a purchase on account, net method. On January 1st, Shirts Are Us, a merchandiser, takes this point of view. You take this point of view, please. Take the point of view of a merchandiser. Purchase 1,000 t-shirts from Molina Company, a manufacturer of various types of clothing, on account for $5,000. The credit terms are net 30. So basically, Shirts R Us needs to pay Molina Company within 30 days after they receive their invoice or their bill. It says journalize the transactions. So let's do that. Here, even though it says net method, it doesn't really affect you because there is no discount given. It's just net 30 days. So you want to put the date, January 1st. We're going to take Shirts R Us point of view. So we're going to debit merchandise inventory because we're purchasing that and our inventory goes up. So that's a debit. You're going to credit accounts payable because it does have that term on account. And because we received that inventory and we didn't pay for it right away with cash, now we owe someone, which is in this case Molina Company. We owe someone in the future. So that's accounts payable credit. And if you notice here, I put Molina Company to signify that it is from them and not any other supplier or vendor. And that will help us with our subsidiary ledger. And then finally, a description. We just purchased inventory. So remember, I know it says net method here, but it doesn't really take into effect because we didn't have any discounts in the credit terms. Here's our next example. It's a payment to the vendor. We're continuing the previous example. On January 28th, Shirts R Us paid Molina Company. Journalize the transactions. So again, we're going to take it from the Shirts R Us point of view. We're going to date the journal, January 28th. We're going to debit accounts payable, Molina Company. This is a liability account. It's decreasing, so we have to debit that liability. It's going to decrease by the total amount that we owed them, which in this case is $5,000. And then we're going to credit cash because we're paying them cash for the inventory that we purchased earlier in the month. Also $5,000. And then a brief description here, I'll just put paid supplier. So that's the simplest example of a purchase and a payment. It is a net method, but there was no discount, so it didn't really affect the amounts. So let's go to this one. Purchase example number 2. Purchase on account, net method. On January 1st, Shirts R Us, a merchandiser, purchased 1,000 shirts from Molina Company, a manufacturer of various types of clothing, on account for $5,000. So here it is. The credit terms are 2/10, or if it's after the 10th day, net 30. Journalize the transactions. So this is where it's going to affect you because it's net method, because there is a discount given. The first thing we're going to do is I'll break down the math or the calculations. Since it is assumed that the discount will be taken because it is net method, we're going to multiply the 2% times the $5,000. That will give you $100, and that's considered the purchase discount. We're calculating this so we could subtract that from the $5,000 because again, net method assumes that the discount is being taken. So let's date our journal here, January 1st. We're getting inventory. That's an asset that's going up. So we're going to debit that. Debit merchandise inventory for $4,900. How did we get that? It's $5,000 minus $100, which is the purchase discount. Your accounts payable, again, it needs to be specific in this chapter because of the subsidiary ledgers. It's AP / Molina Company for also $4,900. And then I'm going to put a quick description here, purchased inventory. That's a key point there. I know it says $5,000. However, you must assume, because it's net method and there's a discount in the credit terms, that we are going to pay early, okay, as a purchaser. So that's why we only recorded at cost $4,900 for the merchandise inventory. All right, our next example, it's the same thing. It's continuing from the previous example. It's a payment to the vendor. On January 9th, Shirts R Us paid Molina Company. Journalize the transaction. If you notice, the date is January 9th and the original transaction took place on the 1st. The credit terms were 10 days. So yes, Shirts R Us, we did end up paying early. So debit accounts payable, Molina Company for $4,900, and then credit cash for the same amount, $4,900, and then a quick description, paid supplier. But in the real world, not everyone pays early. So our next example coming up is an alternate payment to the vendor. So here it is, purchases example 2.2. It's an alternate payment scenario, payment to vendor, net method. So on January 20th, Shirts R Us paid Molina Company, journalize the transaction. So here, the original transaction, if you recall, took place on January 1st. Okay, so January 1st, and the credit terms were 2%, 10 days. The date that we're working on right now, January 20th, is way beyond the 10 days. So here, we did not pay early. We, as in Shirts R Us. And because we didn't pay early, we cannot take the discount. So here on January 20th, the first thing you want to do is clear out the accounts payable for Molina Company. Originally, it was $4,900. So we're going to put $4,900 right here for Molina Company. Next, we want to debit merchandise inventory for $100. If you notice there, we're increasing the cost or the value of the merchandise inventory for $100 because our cash that we're going to pay is for $5,000. Okay? So paid supplier. Hopefully that makes sense. Again, we didn't pay early, so we have to pay the full amount of $5,000. There's a difference between the debit and credit, and that's $100. And that will go to the merchandise inventory account to increase its original cost from $4,900. Next, let's go over example 3, purchase returns and allowance. On January 5th, Shirts R Us, a merchandiser, returned 50 shirts to Molina Company. The credit terms were net 30. Original purchase took place on the 1st. So the 50 shirts originally cost $5 per shirt. Journalize a transaction. This is just a return. Shirts R Us didn't want the shirts anymore, so they returned it back to Molina Company. The first thing you want to do here is let's do some calculations because we need to figure out how much the shirts values were or value is. So 50 shirts times $5 a shirt equals $250. Of that $250, that's the cost of the shirts, and that's what we're going to return, not refund. So January 5th, you want to do accounts payable, Molina Company, because we're returning it back to them. We, as in Shirts R Us, that's going to be $250. So $250. And then you want to credit merchandise inventory because you're returning the inventory back to them. We're going to assume there's nothing wrong with it. We're just returning it. $250. And then you want to do a quick description here. Return merchandise or returned inventory back to Molina Company. So that's an example of a return with credit terms of net 30. So net 30, again, there was no discounts or anything like that. It was only, it's for the full amount. In this case, it's $250. Our next example right here, example 3.1, we're going to do another purchase return on January 5th. It's another scenario. Shirts R Us returned 50 shirts to Molina Company. And then really the only difference here between the last slide and here is we have these terms. So this is a different scenario. We have 2% in 10 days. Just like the last example, 50 shirts originally cost $5 per shirt. Let's journalize the transaction. So 50 shirts times $5 per shirt will give you the $250. But because originally this was discounted at 2%, you have to multiply that $250 by 2%, which will give you $5. So $250 minus $5 equals $245. We need to do that because it is under net method, and the original, you have to assume that the original transaction date we discounted it already on the journal entry. So we have to do the same thing when we're returning product. So January 5th, accounts payable Molina Company, you get a debit not for $250 but for $245 because of that discount. You get a credit merchandise inventory for the same amount, $245. And then we want to write a quick description here, return merchandise or returned inventory. Again, just two different scenarios from this one and the last slide. One slide had no discount terms and this one had discount terms, so you have to consider that when returning merchandise. All right, next up, we purchased all our merchandise. And now we're going to turn it around and hopefully sell it to some customers. So we're going to take care of or talk over the sales side. So here's the sales side right here in the operating cycle for a merchandiser. What's important here is we hopefully sell some stuff, so that's considered sales. Let's assume it's on account. So we're going to deal with accounts receivables. We're waiting for our money, so we're doing some collection and then we get our money. Here, just like the accounts payable subsidiary ledger, you must also take into account an accounts receivables subsidiary ledger. And just like the accounts payable subsidiary ledger, this records or keeps track of separate records for each of your customers. Because again, it wouldn't make sense if you kept debiting and crediting the same accounts receivables for different customers. We wouldn't be able to keep track of what we expect to receive from people and what we're charging people. Again, accounts receivable, and usually in the subsidiary ledger, it's the accounts receivable dash the customer name. Like I said previously, merchandise inventory is important because that is an asset. It's recorded at cost. It will affect our inventory system, whether you're using periodic or perpetual system, but more specifically the perpetual system. We're going to use that throughout our examples. And as a reminder, it is updated continuously with purchases and sales. So record inventory decreasing, I put there when you sell something. And as to emphasize, merchandise inventory is an important asset on the balance sheet. Okay. Next, we have sales. Sales, as I stated previously, is your revenue account if you're a merchandiser. Remember, if you're a service, it's fees earned or something fees. But for a merchandiser, the revenue account is called sales. Okay? And sales is when you sell your goods or provide your goods to the customers. This right here is a revenue account on the income statement. So sales is classified as a revenue and it can be found on the income statement. Income statement. It's very important because it relates to also an account called cost of goods sold. Cost of goods sold is the expense related to the sale that needs to be also stated or reflected on the income statement. Cost of goods sold. It's the next line after sales before you get to gross profit. And as a review, periodic versus perpetual. A lot of the examples that I go over in this video is perpetual, where inventory is updated continuously. You record inventory going up when you purchase it, and you record inventory going down when you sell it to your customers. So record and keep track of inventory continuously. Purchases and sales. So let's go over some sales examples. Here's sales example number 1. Again, we're selling to a customer. We're going to assume that it's cash sales on February 1st. Shirts are us. We're going to take their point of view. We're a merchandiser. We sold 2 shirts to Jerry Rice for $30. Jerry paid with cash. The shirts originally cost Shirts R Us $5 each to purchase from a vendor. Assume that Shirts R Us uses a perpetual inventory system. So first thing we gotta do is break down the calculations here. We sold 2 shirts. We sold it for $30 each. So that's going to give us $60. And that $60 represents sales. Finally, we want to calculate the cost of goods sold. 2 shirts times $5. That's what it cost us to get the shirts before we sold them. 2 times 5 is $10. And again, by definition, that is the cost of goods sold account. Let's do the journal entry here. February 1st. The first thing you want to do is you want to debit cash because Jerry gave us cash. This is for $60. Second thing is you want to record sales. That's going to also be for $60. Now you're not done yet because this is a perpetual inventory system, so we have to record that and also record the expense, which in this case is the cost of goods sold. We already calculated that. It's $10. And then we want to decrease merchandise inventory because we're keeping track of inventory going up and down. In this case, it's going down because it's a sale of also $10. And I'm just going to put a description here, customer sale. If you notice, there's a debit and a credit, a debit and a credit. So if it's a perpetual system, you must always have at least 4 accounts, okay? All right, next example is a credit card sale. So on February 1st, Shirts R Us, they sold 3 shirts to George Constanza for $30 each. George used his Visa card to pay for the t-shirts. So main point here, it's not cash, it's a credit card, okay? Oh, by the way, the shirts originally cost Shirts R Us $5 each, just like our previous example. And again, we're going to assume that it's a perpetual inventory system. So let's do the math here. 3 shirts times $30. And the sale for George is going to total up to $90. That's considered sales. Let's do 3 shirts times $5 because that's what it cost us originally, $5. That will give us $15 for the cost of goods sold. It's important to note here that when we record a sale, we also have to record the expense related to that sale. Okay, the expense here is the cost of goods sold. We couldn't have sold those shirts and resulted in a $90 sale without first the expense of $15. So let's record it. February 1st, cash is your debit for $90. Record the revenue account, which is sales in this case, for also $90. Record the related expense, which in this case it's considered cost of goods sold, for $15. And because it's a perpetual inventory system, we want to lower the inventory because it's going down. So credit merchandise inventory for $15. We're going to add a description here, and the description is customer sale. And there you have it. A debit and a credit, a debit and a credit, 4 accounts, recognizing the revenue, the expense, and reducing inventory because it's a perpetual inventory system where you keep track of it at all times. All right, next we have sales example number 3, sales on account net method on January 5th, Shirts R Us. Again, take their point of view because we're the ones selling. A merchandiser sold 10 shirts to Joe Montana for $30 each on account. The shirts originally cost Shirts R Us $5, purchased from a vendor. Assume that Shirts R Us uses a perpetual inventory system. Here are the credit terms, 1% within 10 days, or net 30. Journalize the transactions. So this is important here because it is the net method and there are credit terms, and the credit terms does offer a discount. So you have to take that into consideration. Let's do some calculations. 10 shirts times $30 each equals $300 worth of sales. Next, we're going to take the $300 and multiply that by 0.01 because of the credit terms when we're assuming that we are taking the discount because it is net method. That'll give you $3. So $300 minus $3 equals $297. That is your sales and not the $300 because of the net method, and we're assuming we're taking the discount. Let's calculate the cost of goods sold. It's 10 shirts, originally $5 each, so 10 times 5 equals $50 for cost of goods sold. Now we're going to do the journal entry. This took place on February 5th. We're going to debit accounts receivables, Joe Montana, because it's on account. So Joe Montana, and you have to be specific with the customer on these journal entries. Here we're going to take the $297 because again it is net method and not the $300. So $297. You're going to credit or record the sales for the same amount, $297. Now we're going to record the related expense. The account is referred to as cost of goods sold because it cost Shirts R Us, in this case, $50 to acquire that inventory before selling it. You're going to credit merchandise inventory because you have to keep track of the inventory going up and down. In this case, it's going down because of the sale of also $50. And here is our description, customer sale. Main point there, don't record $300, it's $297 because it is the net method. And we are assuming we're taking the discount. All right, here the example continues. We receive the customer payment. It's on February 14th. Remember, the original transaction was on the 5th. So they receive a payment of $297 from Joe Montana. The original sale, like I just said, took place on the 5th. It is the net method. So you're going to record $297 because what eventually happened was the customer paid early. So February 14th and February 5th, that's within the 10 days. So we're just going to record $297. So Joe Montana gave us cash of $297. So that's a debit to cash. Then you want to credit accounts receivables, Joe Montana, because now we are no longer expecting to receive that money since we just got it. So accounts receivable, which is an asset, is decreasing, and that's why you're crediting it for, again, $297. You want to put a brief description here. It's customer payment. Now, what if Joe Montana did not pay within the discount period? In that scenario right here is an alternate example of the receipt of payment from Joe Montana. Here, if you notice, it's on February 27th. And remember, the original sale was on the 5th. Okay? So receipt payment from Joe Montana, the original sale, which totaled $297, took place on the 5th. And on the 5th, we assumed that the customer would pay early because it's net method and we valued it at $297. But here it's beyond 10 days. See, it's February 5th and we didn't get the payment until February 27th. So we have to kind of record the difference, okay, which is that $3. The first thing we want to do is calculate the original amount. So here we call original sale. And the original sale was worth $300. And if you don't remember that, just go back a few examples ago when we calculated the $300. So with that said, since we knew the original sale, let's do the journal entry. February 27th, you want to debit cash. And you're going to get not $297, but $300 because Joe Montana did not qualify for the discount and paid way beyond 10 days. Next, you want to credit sales for $3. And then your second credit is accounts receivables Joe Montana for the open account of $297. And if you notice, the debits and credits equal one another. Now, let's go on to our next example, sales example number 4, sales account on account gross method. So this is our first example of gross method. On February 5th, Shirts R Us, a merchandiser sold 10 shirts to Patricia Willis for $30 each on account. The shirts originally cost $5 to purchase from a vendor. Assume that Shirts R Us uses a perpetual inventory system, and the credit terms are 1/10 net 30. Journalize a transaction. Okay, so it's offering credit terms there, and it's offering a discount from the 1/10, 1% it paid within 10 days. Let's calculate the sales. For this example, it's 10 shirts times $30 each, which will give you $300 worth of sales. Now we're going to calculate the expense related to the sale. So 10 shirts, and Shirts R Us originally got those shirts from their supplier for $5 each. So 10 times 5 equals $50. And again, that represents your cost of goods sold. If you recall in the previous slides, we subtracted for the discount, but you don't do that here because we're using the gross method for this example. So February 5th, you're going to debit accounts receivables for Patricia Willis, and that's going to be for the full $300. And I stated earlier in the video that when I worked in accounting, we always used gross method, and we never assumed that the customer would pay early. So this is what the journal entries would look like in the accounting system here. So debit AR $300, record the sale for $300 as well. Recognize or record the expense related to the sale, which is cost of goods sold for $50. And because it's a perpetual inventory system, we're going to decrease merchandise inventory. That's how you credit that by, or you decrease it by crediting it for another $50. And then a quick description here is customer sales. So again, $300 full amount for the sale because it is a gross method, and we do not assume that the customer will pay early. Okay, so the next example here, we're going to receive the customer payment. We received the customer payment on February 14th from Patricia Willis. The original sale of $300 took place on February 5th. This is the case where the customer actually paid early because if you look at the terms, it's 10 days. And because we're using the gross method, now we have to record the discount. In net method, you recorded the discount right away. In gross method, you wait whether or not the customer does pay early. So in this case, they did, or she did. So 300 times 0.01, that's a discount of $3. So $3, and that's our discount. And now we're going to record it now and not previously during time of sale. So 300 minus $3 equals the $297. What does that represent? Patricia Willis will not give us money of $300, but instead give us $297. So on February 14th, we're going to debit cash for $297. And next, we want to recognize or record that discount for paying early. So we're going to debit sales discount for $3. And then finally clear out the accounts receivables account for Patricia Willis for $300 because that's what was originally recorded, and now we have to clear that account out. Originally it was debited, and now you got to credit it for $300. And then of course a brief description of customer payment. Our next example is an alternate example of receipted payment from Patricia Willis. So instead of paying early, Patricia Willis ends up paying on February 27th. Remember the sale was $300 and the original transaction took place on the 5th. The credit terms were 1/10 and 30. And remember, it's gross method that the company is using. So if you notice here, February 5th and February 27th, that's way beyond 10 days. So Patricia Willis will not qualify for the discount. And the main point here is we're not going to record any discounts like we did in the previous slide. So let's do the journal entry. It's February 27th. Received cash for $300. And you want to credit accounts receivable because you want to clear that out for Patricia Willis for also another $300. A lot more it's simpler because we don't have to record any discounts. And finally, a description, a simple description of customer payment. Next, we're going to go over an example of uh, sales on account, gross method with sales tax. So a quick example of how we deal with sales tax. On March 11th, shirts are us, that's us. We're a merchandiser. We sold 8 shirts to George Kittle for $30 each on account. The shirts originally cost Shirts R Us $5 each to purchase from a vendor. The sale is subject to a tax of 4%. Assume that Shirts R Us uses a perpetual inventory system. Journalize a transaction. So let's do our calculations. First, we sold 8 shirts times $30 each. So that's going to give us $240. That $240 represents our sales number because that's what we sold it to George for. After that, we are going to take that $240 because it's subject to tax or sales tax and multiply that by 0.04, which is a 4% tax. That will give us $9.60. So the tax on the transaction is $9.60. Let's also calculate the expense related to the sale. 8 shirts times $5. That will give us $40, and that represents an expense called cost of goods sold. What you got it for before you sold it. Let's record our journal entry. So this took place on March 11th. On March 11th, it was on account, so we got to do accounts receivables. George Kittle for $249.60. It's not just $240 because that's just the sale for the shirts themselves, but you got to add the sales tax. So $240 plus the $9.60. So it's going to be $249.60. That extra column there, that's what you put the cents there where the 60 is. Okay. Next, we're going to record the sales. And the way we do that is a credit. And remember, it is only for $240 because that's what truly what the sales number is $240. We have an additional credit and that account that credit is to the account sales tax payable. And that's for $9.60. Sorry about the fast transition there, but please check my PDF if you need clarification. The last slide what we're going to do is sales to customers, but in respect to refunds, allowances, and returns. Instead of going through a bunch of detailed examples, I thought I'd post a Cengage graph here, or chart, which looks really good in respect to journal entries. So here, a situation where the customer does not return merchandise and cash is refunded and paid. There's a debit to cash refunds payable and a credit to cash. But some stores would give what's called a credit memo. You're going to do the same thing. You're going to debit customer refunds payable, but instead of cash, because they're not giving cash back, you're going to credit accounts receivable. Okay? Now, another scenario is the customer returns the merchandise. Okay? So if the customer returns the merchandise, you're going to do the same thing. You're going to debit customer refunds payable and credit cash, or you're going to add an additional entry called, or not called, but where you debit inventory and credit estimated returns inventory, because we're keeping track of inventory, and that's why, and the customer is returning it, so now we have to take account for it. It's the same thing if the store offers a credit memo. You're going to debit customer refunds payable, credit accounts receivable, and then add in that extra 2 lines to keep track of inventory, debit inventory, and credit estimated returns inventory. Our next topic is the topic of freight. There's 2 types of freight. And before we get into that, I highly advise you to pick a point of view, whether you're the seller or the buyer. Remember, a merchandiser is both. So here's seller buyer and here's seller buyer for both scenarios. Which one are you? And as soon as you pick who you are, then you can understand this chart a little bit better. There's 2 types of terms, FOB shipping point and FOB destination. In FOB shipping point, the title or the risk passes to the buyer right away. See, the title passes to the buyer right away. Once it's shipped, actually, no journal entry is required for the seller, but the buyer pays the freight, so the buyer must record that journal entry, debit inventory, in credit cash. In contrast, or in comparison, FOB destination, the title doesn't pass until the goods gets to the buyer. Okay, so no journal entry for the buyer, but because under FOB destination, the seller is required to pay for the freight, they must record a journal entry. And the journal entry in this case is debit, some sort of delivery expense, and credit cash. So those are your two types of freight. These freight terms are usually listed after the credit terms that we just talked about earlier when we did journal entries. All right, the last topic we're going to talk about is the multiple step income statement. And we went over that briefly when we were talking about the differences between a service business and a merchandiser. Okay, this slide right here. So service versus merchandiser on the right, which I need right there. That should say merchandising business, and I'll fix that on the PDF. We're just going back to that. That is the multiple step income statement. That's the biggest difference because for a merchandiser, you need to consider a lot more things. Here, it's sales minus cost of goods sold will give you that gross profit. Then you have to, from the gross profit, you got to subtract selling and administrative expenses. You will total operating income. Nope, not that. Not total operating expense. That's my fault. Let's do that over again. Again, you should total operating income. There you go. So gross profit minus selling expense minus administrative expense equals operating income. You add other revenue and subtract other expense, and you will get income before taxes. Then subtract income, tax expense, and then you will get your net income after that. And I'm going to put the signs over again. There it is. A bunch of pluses and minuses, but eventually you will get to your net income. Please note that you wouldn't have income tax expense if your income before taxes was a negative number. It would just stop there and it would be considered net loss. All right, let's go over an example. And here is our example coming up. There it is. I took that example from Cengage. So multiple step income statement example. The following account balances were taken from the adjusted trial balance for Laser Tech Company for the fiscal year ended December 31st, 20 Y2. Y2 is just a random year. So we have advertising expense, cost of goods sold, depreciation expense, interest revenue, miscellaneous expense, another miscellaneous expense, office salaries expense, office supplies expense, sales, and sales salaries expense. What we need to do is we need to get all these accounts and organize them on the multiple step income statement. Okay, it's just a matter of organizing, finding where they belong. So the first thing we got going on is for a multiple step income statement is the sales. So sales. For sales, we got $912,500. Your next line is your expense line, and the expense line or the expense related to the sale is called your cost of goods sold. Remember, this is what it cost us to buy the inventory before we sold it. And in this case, it's $512,400. And that's a minus. You take sales minus cost of goods sold, you'll get a line called gross profit. You should get $400,100. Next, we're going to consider all the operating expenses. So operating expenses. And remember from the chart that I showed you, operating expenses are broken up into two types of expenses. The first one is selling expenses, and the next one is administrative expenses. So you're going to look on that example and figure out, well, what's a selling expense and what's an administrative expense. The three examples of selling expenses in our example is sales salaries expense for $160,000, advertising expense for $32,000. Wait, $32,500. And then lastly, we had a miscellaneous selling expense. That's $4,320. So $4,320. That will give us a total selling expense of $196,000 800. I'm sorry, $196,820. And what I like to do is put a subtotal here, or put the total in the middle column. On the very left column is just your details, and there's your subtotal there, or your total for the total selling expense. I don't want to put it to the last column yet because we still need to take care of the administrative expense. So our first administrative expense is office salaries expenses. So office salaries expenses, and that is for $82,400. So $82,400. The next one is depreciation expense, office equipment. And if you notice here, there's different types of depreciation. In this case, it says office equipment. And anytime it says office equipment, it's likely administrative, okay? If it was in the sales office, then it would be a selling expense and not an administrative expense. So this depreciation for the office equipment was for $20,000. Here, office supplies expense is $1,650. I mean, if you see the common thread here, if it says office, then it's administrative. And if it says selling, it's selling expenses. And lastly, we have miscellaneous administrative expenses for $1,200. So our total administrative expenses equals $105,000. I'm sorry, $105,250. And there you have totals for your selling expense and your administrative expense. What you want to do is you want to add those two amounts up. And when you add those two amounts up, you're going to total your total, or it's going to give you your total operating expenses. So total operating expenses. And this is the amount that you want to put to the very last column and line it up with the sales and cost of goods sold and your gross profit. So those are our two operating expenses. You want to add those up. You should get $302,400. $302,400. It's a negative because, again, it's an expense, so that's why you're subtracting it. Then you're going to combine that with the $400,100 up above. And when you combine that, it should give you $98,030. And that equates to your operating income. Okay? I need more room here. I'm running out of room. Hold on. We're going to adjust this here, make it a little bit smaller because we do still have a few lines left after operating income. So we're at the operating income line. So we're going to come into here. So there it is. Operating income is $98,030. There is other in this example. So we have an example of other revenues and expense. In this case, specifically, it's other revenue, and that other revenue is called interest revenue. And because it's a revenue account, you must add it back and not subtract. So when you add that back, you're going to add $1,425. And since this problem did not give any information on taxes, we're not going to call this income before taxes, but instead we're just going to get to the final line, and it's going to be called net income. So our net income here is $99,425. And there is your multiple step income statement. If you want to go through it once more, the very top line is your sales. So let's circle the sales there. So sales, your next line is your cost of goods sold, which we subtracted. So there's your cost of goods sold. Taking the difference between the two equals your gross profit. There's your gross profit. And remember, after gross profit, you subtract your two types of expenses, selling expense and administrative, which gets very detailed there. But those are it. That's your selling, and this is your administrative. So you want to subtract that. And the moment you subtract that, well, we totaled the total operating expenses, so subtract the total operating expenses, and you will get your operating income. So equals operating income, which is right here, total operating income. And then you're going to add other revenue and subtract other expense. In this case, we only had an example of other revenue. So there's our other revenue, which is interest revenue in this case. And then finally, because we didn't have any information about taxes, we just went straight to net income, and there it is.